Good evening, good morning, ladies and gentlemen, depending on which side of the planet you're on. My name's Mike Smith. I'm the options specialist for Hawkeye Traders. Delighted that you could make it today, and whether it's getting towards the back end of your evening if you're in the US, or whether it's the start of your day if you're in Australia or Asia, I'm very happy that you're here to listen to what I've got to share with you. I've got a few things on the agenda for today. We're going to look a little bit at volume spread analysis, but more importantly, it's looking at what it's going to take to enable you to be the options trader you can be. And also I've got one heck of a strategy to share with you that I don't think you'll have heard about before, unless you've heard me speak before, which will knock your socks off. So stand by, get pens and paper ready. Just let me know you can hear me okay. That would be fantastic. If a few of you can just pop in to the questions, that's great. Tom, thanks. Brian, Ron, great to see you here. Peter, or thanks Josh, thanks Terry, fantastic, great participation already, guys. That's awesome. That's exactly what I need as a teacher to make sure that you get the best out of me. It is your session, so please feel free to ask questions along the way. I'll do my best to answer them on the session itself, but I do commit to following up any questions I don't get a chance to answer and dropping you a little email through with anything that you need to know. So what I want to start with doing really to make sure that every single one of you walk away from this knowing that there's a vast amount of differences in the experience you'll have had so far with options trading, is I just want to check in on that. So if you wouldn't mind continuing that participation I just got when asking if you could hear me, I'm just going to open a little poll just to see where you all are. So if you wouldn't mind just ticking the box that is most applicable to you, that would be sensational. And as I said, what it does is it gives me a chance to make sure that I'm gearing this towards multiple levels and not just one level of trading. Great stuff. That's half of you voted already. That's fantastic. Really appreciate it. I've got a big mix. Okay, I'm not going to share the results because this is between me and you as individuals, but it just, as I say, gives me a chance to do that. Another 5 seconds. That's 2/3 of you voted. That's sensational, guys. Thank you so much. Okay, that's great. We've got a really wide spread of experiences here. So if I use terminology which is unfamiliar, don't worry, I'll try and explain it if that's so. If I use strategies or talk about things that are unfamiliar, don't worry, you can learn those. And for those of you who are more experienced, I do promise that I've got something that you won't have heard about before, and I'm sure you appreciate the need to cover all bases to make sure everybody gets something from this. So as I said, delighted that you're here, and let's get into the session without any further ado, because that's what is important. It's not me banging on about stuff. Now, just a little bit about me to start things off. I'm 20 years a trader, 10 years a consultant, coach and teacher, and for various institutions, organizations. And I've worked with Hawkeye Traders now as their options specialist for a little over 2 years. I met Nigel Hawkes, who is the founder of Hawkeye Traders, which is a software product that focuses on volume spread and analysis, at the Australian Technical Analysis Association conference. It must be 3 years ago now, and he was very keen to add an options arm to his forex, equities and futures trading. And so that's where me and Hawkeye Traders met, and we've moved forward with power since then. From the UK originally, as you may have detected, it's not an accent familiar to most of you, and has been battered around a little bit further because I've been in Australia for the last 12 years, live in a beautiful part of the world called Perth, about 45 minutes out from the CBD in a 5-acre property, so my partner can play with her horses. So we are a little bit rural here. So just the reason I'm telling you that is that sometimes because we're transmitting this all over the planet and there's a lot of people on the session, we sometimes have a technical issue or two. If that happens, bear with it. This is recorded So if for any reason there is a problem, I will make sure that you all get a recording of it. As a teacher, I'm passionate about seeing other people get results. This is something that really has been the case, whether in higher education or teaching within a business context. That's why I teach. That's what gives me the kick. A bit selfish to see people, to want to see people's lights come on, those aha moments, but that's why I do it. And please make a note of this, Mike at hawkeyeoptions.com. I'd like you to feel free to contact me at any stage about any questions or queries you've had about options trading, and obviously to support you wherever you are. So please make a note of that, and that's all about me. Now, all about you is all about how to bring you from where you are now to becoming an options trader. So we're going to look first at what volume spread analysis is, and then I'll show you an example of that in action with a chart from now. So volume spread analysis has been kicking around for a number of decades, and what happened was Nigel Hawkes really did what most traders have done, is dived into the markets a few decades ago with great enthusiasm, found that it was really difficult to get consistent results, and decided to go on a little mission to find out what worked and what didn't work. And that's a real mission. Knowing Nigel is not one of these shortcut traders who watch a couple of videos and then believe they'll trade. He went into it in great depth, banged on the doors of people from the CBOE, and came up with volume spread analysis plus some other things added to the Hawkeye software, which enabled people to make decisions well. So what we're really looking at with VSA is looking at supply and demand in the market. And to do that, you need to look at volume. And this volume may be buying or selling volume. So what we've got to then ask is, once we've got a handle on whether it's buying or selling volume, and that relates to a number of different factors. There's 63 different components that go to make up Hawkeye's volume bar. You also look at the price bar to see what the action has done in the day. So it's a combination of volume and price. And really, subsequently, of course, then we compare that to other sessions, and it creates what's called a trend, obviously. The trading edge with this particular methodology is you often see things move. You see that supply-demand ratio changing. You see the change in volume before you see the change in trend. Volume is considered to be a leading indicator. Most of the indicators we use are lagging indicators, so they're after the event. And that's anything from a moving average to an RSI, to a MACD, to whatever indicator you want to put on, proprietary indicators you want to put on a chart. They're usually lagging. Volume is considered to be leading. And of course you can use VSA across all vehicles. So what I'm going to do is I'm just going to pop up an EMC chart. So what we're looking for here is, I'll just explain the chart and some of the components on it. You'll see, first of all, obviously we're using bars, but that's my preference. And the yellow dots you see are pivot highs or pivot lows, which are important in terms of the 6 ways of market moves, which is another story for another day. But you'll see also this trend line, or these trend dots, which are either green, red, or white. Not surprisingly, green is buying an uptrend, red is downtrend, and white means the stock is in congestion. So if we subsequently then look below to the next row, this is volume. Now, it not only is indicating the volume in terms of amount, but also the type of volume is. So green volume would be buy-in volume, red volume would be selling volume, and white volume would be neutral. So it's a combination of looking at these two things which indicate whether a trade for us as option traders, or equally so for forex, futures, equities traders, is worthy of our attention or not. And what we often see, as I've indicated already, is we see that change in volume. We see the buying volume coming in prior to the change of a trend. So if we look, for example, at this change from downtrend through congestion to uptrend, what we see is as we move into congestion, we see the buying volume coming in. And so as soon as we're in uptrend, then we can enter. Likewise with downtrend, we saw this downtrend come in as it was coming into congestion. That put it on our radar, and of course we could trade this downtrend then. Likewise here, and this is probably the best move so far, then we've got end of the downtrend, and we've got buying volume coming in, and then up we go. We'd have probably entered on this bar here, simply because we'd be aware of that pivot high there, so we'd want to see a last hour close above that pivot high, and then we'd take advantage of this. So that's really how VSA works. Now, the issue is with VSA, and indeed any trading system, is that it's not all about entry. I know entries are very sexy. You'll have heard time after time, session after session, about how this setup is guaranteed to do this and guaranteed to do that. There's proven evidence of this and proven evidence of that. And of course, if you focus on entries, you're just then going to end up getting burned, because the sole purpose, write this down, the sole purpose of entry is to put you in a trade which has a high probability of going in your direction. That is the sole purpose of entry. Okay, so that's it. Kind of written it down there so you can copy it down. What you do next is really what matters more. Timely exits are absolutely essential. So if one of the first things in a coaching relationship that I would be looking at with a potential client would be to see not only what they're doing with their trading system and entry, but make sure they've got clarity of exits. And there's obviously different types of exits depending on different situations. And again, that's another story for another day. There's one other factor that is absolutely crucial and is an advantage with options over perhaps some of the other financial instruments, is that you've got a range of strategies at your disposal, or if you like analogies, then you've got a number of clubs in your golf bag, and you choose the right one according to the prevailing conditions. So matching strategy to market is absolutely essential, and really that's what differentiates the top 10% of options traders. They've got that nailed. So they've already got a solid system that's been tested and measured, and additionally they've got solid exits, which would be initial stops, trail stops, profit targets, time exits and personal exits. All of those will be in place in their trading system, and they'll have some way of matching strategy to market. And look, of course, ignore data at your peril. So that would be a 3A or a 4. If you wanted 4 things that are going to make the difference between where you are now and where you want to be as an options trader, then those are the 4 things. So all that being said, what I want you to do is ask yourself the question. Look in the mirror and ask yourself your question: where am I now? Have I got a solid entry system that's based on leading, not lagging indicators? Have I got all my exits clearly written, clearly defined, that I update in my trading system and that I monitor on a daily basis? And do I match strategy to market? Or here's the thing, there's no one strategy on the planet that will fit every market, every set of market circumstances. That's why trading robots blow people's accounts up, because they're not designed to look at the overall market before making decisions. So ask yourself those 3 questions, and don't be a webinar junkie, if I may be a little frank here. Make sure you take some action from what you're hearing here. Too often we find that people attend sessions. Look, I've been guilty of this in the past as well. We attend sessions. Oh, that's very nice. Thank you very much, John, Bob, Mike, whoever's presenting, and then you get on with your business as you would before you heard the session. So please, if you hear anything that resonates with you, that you think, oh, look, I could just tighten my game up on that, make sure you take action on that. That will be that will give purpose to you rocking along to this sort of session. Now, also, we want to be trading with the market. So this is, if you like, the other piece of the jigsaw. And what we want to see is we want to see buying volume across multiple time frames. So for directional trading, so for buying calls and buying puts, we use, or indeed credit spreads, weekly credit spreads we can briefly talk about in a moment. Then we can use the 1 day, 2 day, 1 week combination. So we look across those 3 time frames, and as well as there being uptrend on the fastest time frame, we want to see buying volume in all 3. For a longer term spread position and the strategy that I'm going to tell you about in a moment, which is going to absolutely blow you away, we're going to use daily, weekly, and monthly as our 3 time frames. So we match time frames to strategy, as well as matching strategy to market. Now that may sound a little complex to those who perhaps are newer, but it's not actually that hard. It's essentially a checklist. And we can take you through that. And we will take those of you who are new, we've got something special to offer you guys that's going to enable us to walk through each step of the way to make sure you've got everything in place that you need to. So here's a JBL chart at the minute. Now this was with Hawkeye Options, what we do is we run a trade alert portfolio service, which also has education on all of the strategies that we use. That's a monthly subscription service. And the reason we chose that approach is not just to put up some recommendations, because that's just nonsense. It's just back to that entry sexy business that I talked about before. What it's about is giving you the full picture from having a trade idea, including what criteria you would have to look at for entry, through to entry into a portfolio, and then subsequent management. And additionally, of course, because we've set because we started with a set sum, which was $10,000 at the beginning of the year, then we're exercising portfolio management rules as well. So this is this is one that we entered, and we entered actually on a break of this pivot high here. You'll see the trend change. We weren't happy to enter until it had broken this. So we entered on this bar, and we actually set a profit target at 2 ATR, which took us out actually on that bar there, the bar before the pivot high. But we're still looking at JBL. It's still on our radar. We've taken our profit out of the first trading idea, and we're still looking at it for potentially another entry if we chose to go long. So you'll see here we've got green trend, and we've got buying volume coming back in. You see there we had selling volume on these 2 bars. We've got buying volume coming back in, so we're looking for really a break of 26 on the fastest time frame to say, hey, look, it's potentially time to get in. If we look at the 2J chart and the weekly chart, you'll see once again buying volume coming in is signified by that green volume bar. So in terms of a long entry, this would be a Hawkeye setup. We'd wait for the pivot high to be broken. That would stop us getting in right now. And then we could choose which strategies subsequently fit the current market conditions. I trust that's sort of clear in terms of a process. So what about strategy selection? Well, look, bottom line is trading against the market is tough, and though there's a certain appeal and challenge and maverick type sort of rebel thing going on about contrarian trading, for most people, trading with the market is the way we should go. And of course, with options trading in particular, and again with strategy choice, volatility is often the key to strategy selection. So really we can set up a relatively simple system that matches strategy to market just simply using the S&P 500 and the VIX. It can give us huge clues as to which strategy may be suitable. So if we look at the now, what we've seen over the last 2 days is the S&P 500 going back into downtrend. What does this mean for us? Well, it really means that we probably wouldn't be that keen on entering a directional trade, entering a bought call. So with JBL, we might look at that and say, hey, look, looks like bought call city, but the S&P 500, it has just clicked into downtrend. I suspect it'll go in congestion fairly soon. It is still trading between a range of 2040 and 2100. And of course, we've got the Fed interest rate decision next week, which is going to influence it significantly. But really, oil's demise over the last couple of days has really hurt the market generally. So we will be very, very cautious to the degree either way where we might switch off buying calls completely, or it may be that we position size lower than we would normally do. And again, part of what we teach is how to position size for option strategies. So if we look at the VIX, let's go into an S&P 500 weekly chart, and you'll see that that's in congestion. And again, you'll see that range of that recent range between 2040 and 2100, but a longer term between 2000 and 2100 as well. So with the weekly chart in congestion, although we do see buying volume, and the daily chart getting upset a little bit by the noise created by oil, that's still not a compelling reason to go headlong into a bought call position. But it might be considered. This could be evidence to say, hey, look, recognizing the higher risks of this, let's buy 10 contracts rather than 20 contracts. If we look at the VIX is in congestion as well. Now, for those of you less familiar with the VIX, it measures implied volatility in options. So when the market's a little upset, the VIX will go up as implied volatility in options increases, and when the market's feeling a little calmer, it'll come down again. Now, this is important for a couple of reasons. First of all, we can match this, so we've got the VIX, the daily VIX in congestion, we've got the weekly S&P 500 in congestion, and we've got the S&P 500 in downtrend. So that's not a compelling argument for buying calls. It may be, unless it's more a position size. It's not necessarily, or not either, a compelling argument to go diving into put options. So really, both of those suggest, well, maybe we look at something else as a strategy. The other thing, of course, is that volatility is still pretty low, and this sucks for credit spreads. If you're interested in trading weekly credit spreads, this is the ideal market situation. Now looking at the VIX, seeing higher volatility, higher implied volatility dropping means that you get a premium to enable you to put the position a little further away and reduce the risk. So this is not the best set of market conditions for trading credit spreads either. It's okay, but it's not, again, it's not ideal. You're going to have to fight hard to get some premiums, or look at sectors which are moving, individual sectors which have high implied volatility. And certainly financials were the case sort of early in the week. And end of last week, we actually put up an alert for Morgan Stanley for a bull put spread. We didn't enter it. It didn't meet our entry criteria. It needed to break 35.50 from memory, but nevertheless, we felt that was reasonably, because implied volatility was high. We could put it 4-5% away and still bring in a reasonable premium from that trade, which would expire next week. So we're looking at making 12 cents a share for essentially $1 investment in your margin requirement. So, but we haven't entered that. And that's why entry criteria are important. You need to have the ticks. So I hope you're sort of starting to get the picture in terms of how this all fits together. And obviously our job, or my job, is to guide you through that a little further for those of you who are going to go on a bit further. There does seem to be a little delay whenever I'm switching slides, and so I'm just going to put a little gap between slides, if that's okay, from now on. So, look, credit spreads are out there, weekly options, yeah. Well, there's masses of people teaching this stuff and getting very excited about it and making promises which are perhaps a little misleading because really the bottom line is that there is no one strategy to trade all markets, and if you do that, you're going to get hurt. And secondly, there are market conditions which don't suit credit spreads. And thirdly, you do exit, and fourthly, you don't roll over because that's just kicking the can down the road, and that's often usually not the place to go, unless you've got a trading plan which says these are the particular situations you can do it. So, are credit spreads worth trading? Absolutely, but you need to have a system that matches it to market. So credit spreads are the best place, we've already suggested, when there's some uncertainty exists. We can look at the VIX and say, hey, look, implied volatility is generally high. We could look at financials in light of the Fed decision next week and say, hey, look, bit of uncertainty there. Implied volatility on financial stocks, on options on financial stocks is pretty high at the moment. So we can say, well, look, maybe that's worth a look. And what we're essentially doing is mirroring one of there's two types of risk, and there's the risk of a loss occurring, and then there's the risk of or the risk associated with the actual dollars that will result in. Okay, so with credit spreads, what we're trying to do is we're trying to reduce the risk of a loss occurring by putting it away from the action. So if something is trading at $40, then we may put our credit spread at 36, 37 as a bull put spread, meaning that as long as it finishes above 37, then we take the premium that we've brought in. So that's really the idea of credit spreads. So you need to be looking at taking it far enough away that's going to give you a reasonable premium, but is also going to reduce the chances significantly of risk. Now, the worst market conditions to trade credit spreads are where there's low volatility, and it's staying low, because that means you have to put it quite close to the action. And unfortunately, most of the market between January and August, before we had that big pullback, with very few exceptions, the market didn't suit credit spreads. And for those of you less experienced, we can place two put option legs below the price action if you think the market's going to go up or sideways, or a bear call spread, which is where we place two call option legs above where the market's trading now if we think it's going to go down or sideways. The idea is both legs expire worthless and we scalp a net credit that we've brought in at the start. Shorter duration is good. I would tend to look, and what we tend to look in Hawkeye Options portfolios when we put them in, and like we did with the MS, is a duration perhaps of 2 weeks or less. But if it goes wrong, then it can hurt. And this is the problem with much of what people are taught out there, is it's not okay if it's above a strike price if there's a sell signal that occurs. So what people tend to do, for example, is they would, oh, it's okay, it's above, I've got a 36, 37 bull put spread, I'll just hold it. It's still above 37. Meanwhile, there's a screaming sell signal above that level, and where you could exit, reduce the risk, and look around for other opportunities just removed off the table for very little loss at all. What people tend to do is they hold on, and ultimately they'll get smashed, and all of a sudden a 12 cents potential gain becomes an 88 cent potential loss, which is significantly worse, of course. And although win-loss ratios, this is important too, an important thing to grasp. With directional trading, what's important is average win versus average loss. So, for example, when we did that 250% last year, just to answer a question, the Hawkeye portfolio is at 92%, I think, this year when I last looked. So needs updating today, but 92% it was yesterday. So when we did all the time measuring and all of the variables included in what we were doing last year, we found that the win-loss ratio was actually just a little over 1 to 1. However, the average win was 60%. The average loss was 20%. So we had a 3 to 1 average win versus average loss. Remember that. Keep your losses short, small, let your profits run. That old market cliche, which is absolutely true. So that's what made the difference. So again, those timely exits, etc., that we talked about before. However, even though average win versus average loss is particularly appropriate during directional trading, it's not, and win-loss is less important. Win-loss does matter with credit spread trading, because essentially if you let things run to their maximum loss, even though that individual trade doesn't rip the shirt off your back, what happens is that you can remove the profit from 4, 5, even 6 trades with one loss that you've just poorly managed. So you need to really have an exit strategy which takes you out early, before the major damage is done. And B, you need a high win-loss ratio. And for credit spreads, you're wanting to see a 4-to-1 ratio of wins to losses. Now we've got a strategy that we're using at Hawkeye, using a wide bar, which some of you may have heard me talk about before, which gave an 18 to 2 win-loss ratio when we put it out there, and we actually handheld people through. This is a new strategy using this or a new way of using this particular indicator with this strategy, and so guided people through the process, and that produced an 18 to 2 ratio. That's the sort of ratio you need with credit spreads to do well and for it to make a difference. So just to bring credit spreads to a close for now, it's not ideal in a low volatility market, so I want high volatility preferably to low volatility, and there may be additional opportunities around earnings season, and also when there's things like a Fed interest rate decision, which is very much in the balance with particular sectors. Just that makes some sort of sense. Just going to have a quick look through questions before I introduce you to this explosive strategy that's going to knock your socks off. Yeah, look, I do reckon, I hope it's improved a little bit with slowing down between slides in terms of the audio. Yeah, I do recognise that there's been a couple of issues there when I've changed slides, so bear with me. I do apologise, and there will be a recording available, as I said before, for those of you who want to have a look. Okay, so just to bring all that together, if we're to look at JBL, then what we might consider with a JBL, with it being where it is now, we'd look for a break of 26, and we'd either look for a low position size bought call, or we'd look for a short-term credit spread, perhaps looking at 24-25 to trade this particular stock. There is one other strategy which I like instead of a bought call when there's a market like this, which would be an out of the money butterfly. Okay, so what we might do with this, which is low cost, and suggest that something would be in a range. But we can move that range anywhere we want. So it's not an unreasonable idea to say, well, look, if JBL breaks 26, there is a reasonable chance that it's going to trade subsequently between 26 to 28. There's the buying volume there. It's broken a pivot high. That's the next obvious range. So what we may do is we may put a butterfly, an out-of-the-money butterfly trade at 26, 27, 28, which would give us profit if it stayed within that range, but also be very low risk in terms of potential dollar loss, with a high probability of success, because it's not unreasonable to assume it would, looking technically, it's not unreasonable to assume that it would be in that range. And that would cost us probably somewhere in the region of 21, 22 cents a share, with the potential to, we would probably take 60 cents a share if it got to that point. And that would be a option series expiring within the month usually. So what I'm trying to do is just give you the basics and then look at examples of the basic rules of the game. Some of which you'll have in place, some of which you may not, and bring them all together to give you the best chance of having success on a relatively sustained basis, because that's what we all want, isn't it? Right. I did promise this. Okay. So let's say we like Coke, okay, and Coke's not in a bad place. We need to see it. We need to see it break over a pivot high. It's currently struggling at the moment to break 43.50. But let's say we like this as a longer-term trade. And so we fancied the idea of exposing ourselves to this to the tune of 1,000 shares at $43.10 per share. So equaling an investment of $43,100. Okay. Now we could of course buy a long-term option. Okay. We could of course buy a bought call long-term, and this is the May series here. We could buy a long-term $43 call for, let's say, 174, and that would be okay. Now there's two issues with that, of course, is that first of all, an out-of-the-money option has a delta of 0.5. Now for those of you who are relatively new, what that means is a delta is an indication of how much the underlying option value moves compared to the value of the share. So options don't move one for one with the underlying share. The second thing, of course, is that there is no obvious protection with that. However, we've got a capped loss with a bought call. But there is another chance, another choice, and this is based on strategies that are out of the mainstream of normal option traders. And many hedge funds, for example, use synthetic options positions to create a hedge for stocks or to create a hedge for other options positions that they're in. And this is the basis on which many hedge funds do well. And so this would not be unusual to look at something like this for a hedge fund. So a synthetic option mirrors another financial instrument, essentially, is the bottom line. So what we could do is, if we bought a $43 call, as I've already said, that would probably cost around about, let's say 170, okay, just 171, okay? And we can see that here. This is taken, I just grabbed this from Yahoo Finance before we started, just so you had real figures to work on. And the delta on that is 0.5. If we then sold a $43 put, that would bring in, because we're selling a put, about 183 or 184. So what we have now is two options positions with both, which have now a combined delta of 1. So that means when it goes up, it'll increase by 1, and when it goes down, it'll decrease in value by 1. Okay? So the share moves 10 cents up, then the combination of these positions moves 10 cents up, moves 10 cents down, and the combination of these positions moves 10 cents down. But it's not cost us $43,100 to have this exposure. We've spent 171 and we've brought back in 184. So we're actually being paid to hold this position of 13 cents per share. Isn't that good? You're getting paid for holding something. So it's not just free in this case. You're actually being paid to hold it. Do you get that? How good is that? Eh? But of course, we want to put some protection in. Okay, we don't want to just leave it unexposed. So let's buy a put option that expires in May as well, and that will cost us 140. Okay, so the total cost for a protected position that moves 1 for 1 with shares is 127, which is 140 minus the 13 positive that we got in. So for 10 contracts is $1,270. If we're to buy the shares and put protection in, it would be 140. That would be 1,400 plus for the put plus 43,100. So that'd be $44,500 versus $1,270 for exactly the same exposure. Tough choice. Now, for those of you who like covered calls, may have done this before, why would you invest $43,000 or $44,000 if you want to do a call of $44,500 in a caller strategy when you can have exactly the same exposure for $1,270? Now, this is not, you can't say that a bought call is exactly the same exposure as buying the share because it doesn't move the same. This will move the same, 1 for 1 up, 1 for 1 down. if you were to sell a call for January, we'd bring in 40 cents a share. Let's say if we sold a $44 call, so we brought in $400, which does two things. First of all, it pops $400 in our account. Thank you very much. And if it does go up to 44, then we can close that out and decide whether we continually go through to May. If we made 40 cents a share through to May from now, that will give us 5 sells. That would be $2,000 profit. Okay, and then whatever's left in the value of that underlying position would add to that. So by doing that, we've more than paid for that. I'd put $730 in our account and potentially a lot more than that if the underlying share has gone up. Wow, hey, that's cool. So now, but we're not going to do this without some learning. Okay, there are a few things that we need to know here that are absolutely crucial if you're going to do this. Okay, so essentially what it is, it's a synthetic protected covered call position, if you want a name for it, but let's just call it Jaws, okay, or no money down. So there you go. So this is what it looks like. Movement 1-for-1 with the share, bought some protection to cover the downside risk. We can sell weekly options or monthly options over the top, but you need to know correct setup, how to manage the risks associated with this, including how to manage margin if we need to take it there, and learn to manage the sold call, because that's absolutely crucial. So that's what you need to know. So look, we've covered a number of bases there, and recognizing that some of you are new to this and some of you are more experienced, it may be that different things suit you. What I'd like to do is give you the opportunity, firstly, to see how we work, to come and have a look in the Hawkeye Options membership area and to see how we work. And then I'd like to give you 2 other opportunities. So opportunity 1 is you're going to get full access to the Hawkeye Options Elite membership for a 30-day trial. Okay? So what that involves is we put trade alerts up. We don't put a trade alert up every day. We look at the market conditions, obviously, and where our portfolio was. So invariably, there's 2 to 3 trade alerts per week. So you're going to get somewhere between, let's say, an average of 10 a month, and a portfolio. So you'll see what happens then. And also that's great learning in terms of taking that idea through entry into a portfolio and then what we do next. So for those who are new, it'd be great. For those of you who are less new, you'll see how somebody else works who's been doing this a long time. And then there's educational strategies with indicative trading plans, etc., etc. And we send you a daily update so you can see prior to market open, so you can see exactly where we've adjusted our stops to, or if we put profit targets in, or whatever we're going to do with any position, it's all there. I'll give you a little market wrap as well. So essentially what you're doing is you're watching over our shoulders, watching exactly how we would trade with those positions. And you can access this at Hawkeye Traders Live. Now, just to answer a question that's already been asked, the subscription to that is a mere $99 a month. Okay, so opportunity 1 is giving you access to 30 days, at which time, if you let us know before that, you want to close your subscription, you don't want to go into the $99 a month, then that's cool. Now, for those of you who are less experienced in options, we're going to run a special session, that should be 8:15 p.m. Eastern Standard Time on Monday, called Kickstart. We're going to give you some information about how options work in a bit more detail and how you can use them to trade any market conditions. We want you to be able to take it easy, and that information is going to be invaluable when you look at how we're putting trades up in the trade alert service in the portfolio. We're going to give you an overview of the main option strategies so you can trade any market. So any market conditions, any market, and we're also going to cover a little bit about what all the fuss is about trading weekly options and how you can move through the hype and know exactly how this could work for you. And we're obviously going to look at matching strategy to market. We've got to do that. And position size your option trades. So that's opportunity 2. Now, for those 2, we're putting an investment of only $49 in. So you've got the live session and the access to the trade alerts. Now, I know that this is going to be of interest to many of you. You'll also get this explosive strategy idea. We're going to take you step by step through this on Tuesday, December the 15th at 8:15 Eastern Time. Exactly what we've talked about. We're going to give you those things that you would need to know to make the decision whether this is something that you want to go further with or not. Okay, so go to that hawkeyetraders.com/live to make this happen for you. So those three things, the trade alerts, the kickstart for those that are newer, or those of you who want a revision, and also the no money down strategy, which is going to knock your socks off. So you can make it happen now for $49. We're not going to add anything else for that explosive session. We're going to just package it all together, $49, and you will, by this time, by market open tomorrow, you'll have your webinar links for the two sessions, and you can choose to obviously choose to attend both or one. These will be recorded just in case you can't make it, and these are on Monday and Tuesday respectively, both at 8:15 p.m. Eastern Time. So that's it. Get busy, get to this session, whichever session is appropriate to you, and look forward to seeing you. You guys are going to take action on this. So really what I want to do now is just answer any questions on this. The particular trades I showed you, or particular trade I showed you with JBL was a breakout. But as I said, what I would be keen to look at is potentially an out-of-the-money butterfly with JBL, or I'm not compelled by the selling that's happened. Oil will stabilize at some point, and already there was some evidence of that last session. So it may be that it's going to take that to stabilize and the Fed to push us up higher up to Christmas. I still think we're going to get a rally into Christmas looking at what the market's doing. I think there's more tailwinds for the right now than headwinds. But it's going to be a market which is going to be choppy. Brian, what happens if the price just goes sideways? Well, look, you make money from selling calls over the top. That's another advantage of just holding the shares. So if we entered that Coke and we made 40 cents every month, you can make more than that if you do weekly options. We made 40 cents, that's $2,000. You've invested $1,700. So if it goes sideways, we're still in profit. But great question, Brian. When is Hawkeye coming up for Think or Swim? Look, that's not our call, obviously, but there are many Think or Swim members who do exactly what I do, is that they have a trading platform that they trade on, and they use NinjaTrader's free service to chart with. So I know Randy, who's the current CEO of Hawkeye Traders, that's exactly what he does with his options. He doesn't trade through Ninja because you can't trade options through them. So you would have two screens. You would have your charting screen and your obviously your trading screen open. So really that's not a drama for me or most people over here in Asia and Australia, and many current Think or Swim clients. Essentially it's a decision. Well, look, do I want charting software that is going to be based on leading indicators, or and being able to use that with just by pressing the tab, the Alt and Tab buttons onto my trading platform to trade? Would I rather do that and have higher probability trades, or must I have everything in the same area, which you have to click to go through to trade anyway? So at this stage, I don't know. Yeah, look, the Kickstart, I think I've answered that that question, Herman. I think the Kickstart would be perfect for you, and because it really does go back to ground zero in terms of knowledge. So what is an option? How does it move? Etc. etc. How does the value move one for one? Well, so let's say that the underlying moved 10 cents higher, and there's a 0.5 delta on each leg. Okay, so what would happen is the value of the bought call would increase 5 cents. Okay, and the buyback cost of the sold put would decrease by 5 cents. So if you were to close it all out, you've made 5 cents on the bought call, 5 cents on the sold call premium that you originally brought in, equals 10 cents, equals moving one for one with the underlying share. We're going to go through that in a lot more detail at the session itself. What commission is needed? Well, it varies broker to broker. I'm sort of reluctant to recommend brokers generally, because invariably they all have their pluses and minuses. Something like Interactive Brokers is fantastic from a point of view of low commissions. You're paying per contract, not a flat fee, so you can test a lot of things out without a fixed flat fee. There are others which, like Options Express, for example, which are very, very user-friendly for people to get going on. There's a really nice demo account on that, which is again easy to use, but they've got a fixed charge associated with any trade. So there's pluses and minuses with each, but the bottom line is that really credit spreads are tricky, because often the fees do impact, because you're looking for scalping a low premium. Then that does impact sometimes on whether a trade's viable or not, if you take it far enough away. If there's a big fixed price up front for just placing a trade for each leg. So you need to be careful. It's one of the reasons why many people don't do iron condors, for example, which is a 4-leg strategy, which in essence is a combination of the two credit spreads. Is fees become inhibitive? So a difficult one to answer. It's different strokes for different folks, but really whether you're successful on a sustained basis should not depend on fees. It's a business decision you're making once you've got those things in place that you need to have to become a great trader. And look, I've traded forex and do trade forex sometimes, and it's exactly the same issue as people get very hung up about spreads. If there's very little difference between a bid-ask spread of one broker and another, if it's 1 pip, then that really shouldn't be the difference between you being able to make a sustainable profit or not. There's more important things with a forex broker, such as how well the order goes through and any slippage. That sort of thing is far, far more important than a 1 pip difference in bid-ask spread, just as an example. Do I use option stop losses? Yes, I do. It's very rare that I would put an all or nothing trade in. There's no reason to give yourself or expose yourself to the maximum risk for any strategy. So yes, is the bottom line with that. Depending type of stop loss would depend on a number of things. With options, we are aware of time value. We do legislate for that in terms of time decay. We do legislate for that in terms of the length to expiry. We trail a stop accordingly. We like to lock in profits. We do have profit targets when there's a technical reason to have one. And then of course there's personal stops. If something is going on in your world you shouldn't be trading, then give yourself the permission not to trade. Get out of the market, sort your stuff out, get yourself back into the proper decision-making state before you come back to the markets. Common sense. So those are all the different types of stocks we use. No, absolutely not. The trade alerts are not credit spreads only. They're actually primarily directional trades. There are credit spreads in there. There are some butterflies in there. There are even 2 long-term diagonal call spreads in there as well. So credit spreads don't form part of the overall jigsaw. As I've said, it's not been the best year at all for trading credit spreads because of the lower volatility. Remember, we're trading within that 4 or 5% range for the first 8 months of the year. So, D, yes, you can. What was the name of the KO chart? Look, we call it a no money down trade. But essentially it's a protected synthetic covered call, I guess, for want of a better term, but nobody else is putting it out there. So essentially it's a combination of a few different options components put together. The trade alert portfolio service is absolutely transparent. We predetermine all of the stops and timing of those. Do you close both legs at the same time when you're doing a credit spread? When you're closing it, obviously with the idea of a credit spread is we'd like it to expire worthless and therefore retain only your initial premium. So one of the potential advantages of credit spreads is you haven't got any exit costs if they do expire worthless. If we do need to exit because something's looking tricky, then yes, invariably we would close 2 positions down. We're more likely to leg into a position than leg out of a position. Does Hawkeye Traders cover only US stocks? No, Brian. There is a way. The Hawkeye Traders plugin works on a number of different plugs into a number of different charting things, and that as long as like for Ninja example, as a basic they have underlying stocks and commodities and obviously forex. You can actually, as their standard, the stocks are US, but you can actually grab data from other sources with Ninja, and Hawkeye will work on those in exactly the same way. Do I have auto trader with a broker? No, I don't. My job as a teacher is the trade alerts and portfolio services there as an education. Is there to guide you how we would trade options, so you can make your choice in terms of whether you want to enter something or not enter something, whether it fits with your plan or not. So we don't do an auto trade service because I'd like to see you being independent, empowered traders is the bottom line. But nevertheless, good question. Yeah, Harish, I've already mentioned the recording's good. Okay, guys, well, I think we've done the questions. I'll double check afterwards that I haven't. So look, for those of you joining us, get busy on hawkeyetraders.com/live. Look forward to seeing you on, as I said, you'll get your alert portfolio education members area access before market open next, before the next alert is put up, if we do put one up for the next session. And also you'll get the 2 webinar links to choose one, both, or neither, depending on what your particular interest is. And you'll get that all in the next few hours. So looking forward to working with you guys who are moving forward. I think, as I said, that's it. I think I've answered all the questions. I'll just hang on a couple of minutes. Michael, you're very welcome. Looking forward to working with you, buddy. How can you learn more about credit spreads? Look, just hang on in there. I'm going to talk about them on the Kickstart session. There's other things that we do that are particularly focused on credit spreads. If you're doing the trial anyway, you'll be able to see the strategy videos on credit spreads and also indicative trading plan. So all of that information is available by taking advantage of the $49 trial, which, as I said, as long as you get the 2 live sessions anyway, the recordings of those are there to be listened to, and you've got a whole month to make a decision as to whether you want to continue with the subscription or not. So that's what I would suggest, Dirk. So it's quite hard. There are quite a lot of people on here. I do apologize. Where'd you go to pay the $47? Just go to that link and it will take you automatically to the pay page. Yes, Terry. The ongoing fee is $99. Okay, guys. Well, look, I think I've answered all the questions. For now, take care. See you later. It's been a pleasure and a privilege. Thanks for your participation. It's been awesome today, guys, and look forward to seeing you again soon. Don't forget that email if you want to ask me anything. It's mike@hawkeyeoptions.com, and the link for those of you going through is hawkeyetraders.com/live. Bye-bye for now.